Thank you all for joining us for this Richey May webinar. This is actually the last in our series of how tax reform impacts the mortgage industry. Today's webinar will be talking about provisions impacting business income under tax reform. Just a few housekeeping items that we want to go through before we get started. Just so you all know, you are all being placed on mute at the moment. We will try to reserve some time at the end of the presentation to address questions. So please type those questions into the question feature on your webinar dashboard, and we'll try to address those as we can. Should we not have time to address all questions at the end, if we run out of time, please note that we will contact you directly. We do get a report of all questions asked and who asked them. So we will follow up with you directly to ensure that your questions get answered. We'll also be providing a recording of today's webinar and the slide deck to all the participants today. So please look for that in the next day or two after today's webinar. For those of you looking to qualify for CPE today, please note that you must answer all 3 poll questions that will be launched throughout the presentation. You do not have to answer the questions correctly. You just need to make sure that you do log in and answer to that. And also, please note that we cannot honor group responses as qualification for CPE, so you must be logged in individually to today's webinar. In terms of surveys, the survey, it'll appear on your screen following today's webinar, so we do really appreciate any feedback that you might have to offer so that we can ensure that these webinars are as valuable for you in the future. And for those of you who do qualify for CPE, those certificates of completion will be emailed to all the participants or all the qualified participants in the next coming days. So do look for those via email. So with that, I want to introduce our 2 presenters today. We have 2 managers from our tax group. Gina West is a senior tax manager here at Richey May, and Kyle Billman is a tax manager as well. So they both work exclusively with clients in the mortgage industry. So without further ado, I'm going to go ahead and kick it off to Gina and Kyle.
All right, good afternoon, everyone. Thanks for joining us. As you can see, here is just sort of a quick agenda of topics we're going to be covering this afternoon. We're going to start off with the taxable year of inclusion changes, or what is now called the applicable financial statement conformity rule, sort of as the lingo. We'll touch on business interest limitations, excess business loss limitations, and depreciation and other cost recovery items. So to kind of start off with changes to rules for the tax year of income inclusion. In general, for accrual basis taxpayers, an amount is included in income when all the events have occurred that fix the right to receive such income, and the amount thereof can be determined with reasonable accuracy. That's sort of the key there. This is considered when the all events test is met, and this applies unless there's an exemption that permits deferral or exclusion. So generally, for tax years beginning after 12/31/17, a taxpayer is required to recognize income no later than the tax year in which such income is taken into account on 1, as income on an applicable financial statement, or 2, another financial statement under rules specified by the IRS. So generally speaking, those of you in the mortgage industry, it's going to apply under item 1 there. So under the new law, accrual method taxpayers, again, must recognize income no later than the tax year in which it's recognized as revenue on an applicable financial statement. Example, the all events test is satisfied no later than the tax year in which the revenue is recognized for financial accounting purposes. So again, this basically just means that for income items, this brings tax and GAAP much more in alignment. So here's the definition of what the IRS is looking for when they say applicable financial statement. And there are 3 basically main criteria, the first of which has some further clarification. But basically, applicable financial statement is defined as a financial statement which is certified as being prepared in accordance with GAAP and which meets one of the three following criteria. So the first of which is for mostly public entities, the Form 10-K or a successor form or annual statement to shareholders required to be filed by the taxpayer with the U.S. SEC. So that'll apply mostly, again, for public entities. But if you're in the mortgage banking space and you're sort of an independent or smaller, mid-size company, you're probably going to really fall into item 2 here. And this is an audited financial statement of the taxpayer, which is used for credit purposes, reporting to shareholders, partners, other proprietors or beneficiaries, or any other substantial non-tax purpose. But again, this is only if item 1 above does not apply to you. It's sort of a successive determination. So if item 2 doesn't apply, then you'd look to item 3, and this would be a financial statement that's filed by the taxpayer with any other federal agency for purposes other than federal tax. But again, this is only if no statement of the taxpayer meets those described in items 1 or 2 above. So again, it's sort of a progressive review here. You sort of look down. If 1 doesn't apply, then 2. If 2 doesn't apply, then 3. Again, most independents, I think you're going to be really under item 2 there. So if you find that item A, as far as the definition goes, that you maybe don't fall into that, then you'd look to items B and C here. So again, this is sort of a tiered analysis. So if A doesn't apply and you find that you're kind of following these international financial reporting standards that sort of meet equivalency to the U.S. SEC reporting, then item B would apply for you. Again, this is only if you don't meet the requirements under item A. And if B doesn't apply, then you'd kind of look to C to say, is our applicable financial statement a financial statement filed with any other regulatory or governmental body specified by the IRS? Again, only if A or B above don't apply to you. So there are certain limited exceptions on items of income related to the applicable financial statement conformity rule. So this requirement does not apply to items of gross income earned in connection with mortgage servicing rights. That was kind of the big ticket item we were all really concerned about, but they did pass that exclusion or exception in the final drafting of the code. It also doesn't apply for items of gross income required to be recognized under any other special method of accounting in the provisions of the code. So some good examples there are provisions for long-term contracts as well as installment sales. And this one is a significant continued benefit there on installment sales, especially for our mortgage bankers, specifically as it relates to potentially those bulk sales of MSR portfolios. Again, income from MSRs will continue to be recognized in accordance with the pre-Tax Cuts and Job Act rules. And basically, this will follow the similar concepts for normal servicing and excess. Normal servicing being recognized or included in income upon the earlier of when they're earned or received under the all events test. And then excess is treated more like those stripped coupons under Section 1286 and is more structured under kind of the OID rules. So that's good news for everyone in this space, especially if you're retaining servicing. This change, specifically to the mortgage industry as well, will affect the income deferral treatment of interest rate lock commitments and the corresponding hedge related to those. As now, basically for tax return purposes, this income will have to be picked up in the same year it's included for financial statement purposes. So while the pipeline is not always the largest tax adjustment on a return, depending where that asset or liability falls at the end of the year at 12/31/17, this could have been a significant item that was reversed on your tax return. And so depending on that value, this could be a robust figure. But going forward, just keep in mind that this will have basically no book-to-tax difference going forward on a carry-forward basis. So what this means is basically due to the new requirement to follow the applicable financial statement treatment, there will be a method change required. In the case of taxpayers that do meet the criteria, especially related to, say, interest rate locks or hedges, this provision will basically apply for tax years beginning after 12/31/17, and the change will be treated as initiated by the taxpayer and made with the IRS's consent. So this is kind of what you'll be hearing kind of in the marketplace, I think, referred to a qualified change in method of accounting for the purposes of the Tax Cuts and Jobs Act. This will be considered an automatic change, and it'll fall under the procedures under Code Section 481A. For an example, if the net beginning of year cumulative timing difference for those interest rate locks and related hedge components result in taxable income looking forward into 2018, then the taxpayer is eligible to spread the impact of that change over 4 years. So that is at least a nice benefit. Unfortunate that they're requiring you to pick it up in income now, but they do give you at least a 4-year spread, so it's not quite as painful to pick that up all in 1 year. If for whatever reason the net of that cumulative difference is less than $50,000, you can elect to recognize it all in 1 year if that's just easier to do so. So that's at your discretion or election. So a good example of what a method change figure might look like as it relates to the interest rate lock and corresponding hedge is just sort of imagine at 12/31/17, you had an asset or pipeline of $1 million, and the corresponding hedge was, say, $500,000 at a liability position. So basically, you had a net $500,000 asset on the books, and that was reversed for tax purposes in 2017. So looking forward for that 4-year spread, you'd basically be able to pick up, instead of $500,000 all in 2018, you'd have $125,000 each of the next 4 years beginning with 2018. So 18, 19, 2020, and 2021. So that would be additional income in those years. And so here we're going to launch the first CPE question.
You should see that on your screen now. We'll give you about 20 or 30 seconds to answer that, and then we'll close it and move on with the presentation. Okay, it looks like most everybody has voted. We're going to go ahead and close that.
So for those of you that just reviewed that question, the correct answer was item A, applicable financial statement.
Another new area of the tax reform code that was implemented as part of the reform is the implementation of a business interest expense limitation. That limitation is going to place a limit on the amount of interest that is deductible for people that fall into certain categories or meet certain requirements. Beginning after 12/31/2017, all businesses will be allowed a deduction for trade or business interest, which we'll discuss later, incurred during the taxable year to the extent the total amount of that interest does not exceed the sum of a few different items. And again, we'll define these in greater detail as we go on. The first of which is business interest income plus 30% of the business's adjusted taxable income, which we will define. And then in addition to that, you would add floor plan financing interest expense as well. For most or all of you, this will likely not be applicable as you're working through this calculation. As a note, this applies to all entity types. That would include C corporations, flow-through entities, as well as sole proprietorships who file a Schedule C on their individual tax return. It would apply to those entities if they do not meet the small business exception, or if they are eligible to opt out of the rules but choose not to, which again we'll discuss later. The first exemption that we'll discuss for certain small businesses and industries is the gross receipts test exemption. Under this exemption, you look at the average annual gross receipts that you have throughout the 3 taxable year period, ending with a prior taxable year. And if the average of those gross receipts over the prior 3 taxable years does not exceed 25 million, then that limitation will not apply to you as a taxpayer. This is kind of something that would apply to smaller businesses or entities that don't rise above that threshold, and that would be an option to get out of being limited on that interest expense. The second one that we look at is the electing trade or business exemption. Now, there are a few industries that have been specifically put into the code as eligible to opt out of these rules and have them not apply. The first would be a real property trade or business. The second would be farming, agricultural, or horticultural businesses. Again, as you can see, those would likely not apply to many of you, but have been provided as provided a exemption in the code. And just as a note, if the limitation is elected out of, businesses will be required to apply a separate set of depreciation rules that generally extend the life of the depreciation over a longer period of time. In defining business interest, we'll look at interest income as well as interest expense. Business interest income would include the amount of interest includable in gross income, which is properly allocable to a trade or business. So this will generally not include any kind of investment interest that may be earned on investments or portfolio type activity. It would just be trade or business type interest. The same is true for interest expense. This would be any interest paid or accrued on indebtedness properly allocable to a trade or business. So again, this would not include any kind of investment interest that is incurred throughout the year, but strictly trade or business interest expense. As a side note, to any of you listening who may be operating as a C corporation, any interest income as well as interest expense, both trade or business and investment, is going to be treated as business interest for C corporations, as they don't separately state those items like other flow-through entities and sole proprietorships do. When looking at the second piece of the calculation, which is adjusted taxable income, there is a formula that you use to calculate that number. There's a number of items that go into this calculation, so we'll try to stay out of the weeds on that too much, but for purposes of laying this out at a high level, the first item that you look at is taxable income. You would calculate your taxable income, and then you would exclude a certain number of items, where you would look at it without regard to a couple of items. Some of you may be familiar with the term of EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a calculation similar to that calculation from a taxable income perspective. So we take taxable income, we pull out any item of gain, income, deduction, or loss not properly allocable to a trade or business. We pull out the business interest income or business interest expense as defined above. Any net operating loss deduction would not be looked at for the calculation. We pull out the 20% pass-through deduction. and we also pull out depreciation, amortization, or depletion from that number as well. So essentially, it's taxable income without regard to the items that we just listed. That becomes your adjusted taxable income that you're going to look at for purposes of this limitation. As a note, for tax years beginning after 2021, the measurement above will be altered to no longer pull out depreciation, amortization, or depletion, and that will serve the effect of further limiting the deduction as the adjusted taxable income number would be lower. So a quick example that we'll run through on this will help to lay out this scenario and when the expense may be limited and when it might not. So the first example, EXCO has taxable income of $300, and included in that amount is $20 of business interest income, $150 of business interest expense, $200 of depreciation, and $20 of amortization. There is no investment in interest income or expense in this example to keep things simple. So first we would calculate the adjusted taxable income, and that would be $650, taxable income less plus or minus those items that we discussed above. Now that we have our adjusted taxable income number, we then are required to multiply that number by 30%. That leaves us with a result of $195. We then add to that number our business interest income as its adjusted taxable income plus the business interest. So that leaves us with $215 of taxable income to be used for purposes of this limitation. We then look at that number and compare it to the total business interest expense incurred. In this example, as you can see, the adjusted taxable income plus the business interest is $215, whereas the business interest expense was only $150. As such, because 215 is greater than 150, there is no disallowed interest expense in this example, and you would be eligible to deduct the full amount of interest expense. In example 2, there's similar facts, but we have adjusted the numbers to show a disallowed interest expense. In this example, there's taxable income of $50, and included in that is $20 of business interest, $150 of business interest expense, $200 of depreciation, and $20 of amortization. Again, no investment interest income or expense exists. First, we calculate our adjusted taxable income, which is $400, taking into account each of those items. We then multiply that $400 number by 30%, which the limitation requires. That leaves us with $120. We then add to that number the total amount of our business interest income, and we are left with the taxable income to be used for purposes of the limitation of only $140. Because the $140 number to be used for the limitations is less than the $150 of interest expense incurred, in this example, there will be $10 of disallowed interest expense due to that number being greater than the adjusted taxable income and business interest calculated above. In example 2, a carry forward was created. There was some disallowed interest expense, and the code allows for a carry forward of that disallowed expense. Any interest expense not allowed as a deduction for any taxable year due to the limitation will be treated as business interest paid or accrued in a succeeding taxable year. So in other words, if you had interest expense that was disallowed, as in example 2, you would carry that forward to the next year and treat it as though that interest was incurred in that succeeding year. As a note, in the case of partnerships or any of you who operate as such, the carry forward occurs at the partner level as opposed to at the entity level. And partners must reduce their basis in the partnership for any disallowed interest expense at the time the carry forward is created and passed out to the partner. The carry forward is indefinite for all taxpayers and will not expire. So in the event that you are able to generate income in the future to utilize that, it will not expire and will be able to be utilized at that point. As a quick note, in the case of C corporations, Any disallowed interest will be treated similar to the rules that apply to net operating losses, and there may be certain limitations that apply when it comes to corporate acquisitions of those tax attributes. There is a double counting rule and an excess taxable income rule that is implemented with these rules. This is to prevent a partner or shareholder from counting the income from their flow-through entity twice. So when determining the limitation at the partner or shareholder level, the calculation should generally exclude their share of the income from an entity that they may have an ownership interest in. This effectively avoids the income being utilized in the calculation at the entity level to determine your interest expense, and then flowing through to the individual partner or shareholder and being used again to determine what their interest expense deduction might be at that level. This double counting rule would prevent that, and we'll go through an example of that later. The excess taxable income rule is essentially the exact opposite of the double counting rule. If you have excess taxable income at the entity level that does not get utilized through the calculation, and none of your interest expense is limited, you can carry through that excess taxable income and use it at the partner or shareholder level in determining their interest expense limitation. In other words, if the income gets utilized at the entity level, it cannot flow through and be used again. If it did not get it utilized at the entity level, the IRS will allow the partner or shareholder to use that excess income in determining any limitations at their level. So a quick example of the double counting rule. ABC is a partnership owned 50-50 by XYZ and an individual. ABC generates $200 of non-interest income, which is essentially your adjusted taxable income. Its only expense is $60 of business interest. ABC's deduction for business interest is limited to 30% of its adjusted taxable income. $200 times 30% leaves you with $60. ABC deducts $60 of interest and reports ordinary income of $140, which is your $200 of income less your $60 of business interest. XYZ's distributive share of ABC's ordinary income is $70. They get half of that taxable income, taxable ordinary income. XYZ has no other income from their operations, so they have not generated any other income outside of their interest in this entity, but they did incur interest expense of $25 outside of that entity. Without the double counting rule, XYZ would be able to take into account their flow-through share of that income of $70 and would be allowed an additional interest deduction of $21. Instead, XYZ excludes the income from its calculation, which results in a disallowed interest deduction of the full $25 that they incurred. This happens because they did not generate any of their own income and as such are limited fully on any other interest expense they incurred outside of that entity. To display the excess taxable income rule, similar facts as the example above, except ABC has only $40 of business interest expense. ABC has a limit of $60 on its interest deduction. The excess of this limit over the interest expense is $20. So essentially, they have not fully utilized all of the income available in the calculation. ABC's excess taxable income is $66.67. XYZ's distributive share of the excess taxable income is half of that. XYZ's deduction for the interest is limited to 30% of its own adjusted taxable income, which is $0, plus its distributive share of excess taxable income from the partnership. So without getting into the weeds too much, what's happening here is the income at the entity level was not fully utilized when looking at the interest expense. As such, the excess that was not utilized is flowing through, and XYZ is allowed to use that excess in determining whether there's any additional limitations at their level. In this case, they are allowed to deduct an additional $10 of business interest, and there is $15 left that will carry forward to future years. All right, time for our question number 2 for the CPE questions.
Should see that on your screen right now. You can go ahead and put your answer in. Give it, again, 20 to 30 seconds, and then we'll move on. Okay, it looks like most everybody has voted, so we're going to go ahead and close that poll question.
The correct answer to that question was B, 30%.
All right, so we're going to move on to the concept of excess business loss limitations. And just keep in mind during the review of this topic that there's sort of two code sections that correlate to this topic. Code section 469, which touches on passive loss rules, and this basically interplays very closely with code section 461 going forward, which is really the discussion of the actual concept of excess business losses. So in general, the passive loss rules under code section 469 limit deductions and credits from passive trade or business activities. And these passive loss rules apply basically to pass-through entity owners. So they apply to individuals, estates and trusts, and other closely held corporations. So under this passive loss concept, deductions attributable to passive activities to the extent they exceed income from passive activities generally may not be deducted against any other income and are then carried forward and treated as deductions and credits from passive activities in the next year. And these carry forwards basically are indefinite until that particular activity is disposed of. So you don't lose the benefit. It's not a permanent difference. It's more of a timing difference. But under pre-act law, code section 461 provided a limitation on excess farm losses that applies to taxpayers other than C corporations. Well, what they did with the Tax Reform Act was taxpayers now will be limited to the use of flow-through or pass-through business losses from all pass-through entities each year to offset their non-business income. So again, this is no longer just applicable to farm losses. It's really across the board, and this is going to be a pretty significant, I think, change to this particular area. So for tax years beginning after 12/31/17 and before January 1, 2026, the Act provides that the excess farm loss limitation does not apply, and instead, a non-corporate taxpayer's excess business loss is disallowed. So under the new rule, excess business losses are not allowed for the tax year, but are instead carried forward, as mentioned, and treated as part of the taxpayer's net operating loss carry forward in subsequent tax years. So the interesting thing is that this limitation applies after the application of the passive loss rules described above. So it's sort of a two-tier process, a very intricate, I think, and detailed calculation will be necessary to determine this, especially if you have multiple passive activities at that sort of, in my mind, thinking of an individual filing. You know, there can be many types of entities that you might have ownership in that you're passive in, that sort of you aggregate together, determine your net passive loss limitation, if any, and then you'd move on to this excess business loss limitation calculation. So keep in mind, a passive activity for this purpose is a trade or business activity in which the taxpayer owns an interest but does not materially participate. And this material participation concept means that the taxpayer is involved in the operation of the activity on a basis that is regular, continuous, and substantial. And there are a lot of specific rules around that. We won't go into detail today, but just keep in mind that's also a thorough analysis that would need to be done there to determine passive or active treatment. So the excess loss limit applies when aggregate business losses attributable to trades or businesses exceed the following amounts, and these are indexed for inflation going forward. So for 2018, this will be $500,000 for married filing joint taxpayers and $250,000 for individuals. Any business loss in excess of the above-mentioned limitations, again, will be carried forward as a net operating loss. And as Kyle mentioned earlier, similarly to the interest limitations, the excess business loss amounts will be treated as NOLs and are subject to the new 80% limitation on deductibility. And keep in mind as well that there's no longer a carryback provision for net operating losses, but there is an indefinite carry forward. So here's a couple pretty basic examples to kind of walk through this concept. So the first one, in 2018, T, a single taxpayer, has deductions of $500,000 from a business. T's gross income from the business is $200,000. So T's excess business loss is $50,000. And this is calculated by kind of an odd formula. It kind of works backwards from what you would expect this to look like. But you start with the deductions of $500,000 and subtract from that the sum of the gross income, so $200,000 plus that limitation amount. So this is a single taxpayer, so the $250,000 limit. So that's $500,000 less $450,000. That leaves you with the $50,000 excess business loss. And that's treated as part of the taxpayer's NOL and carried forward to later years. So, for example 2, basically assume the same facts, but this will be a married filing joint taxpayer. So T doesn't have actually, in this scenario, an excess business loss because the aggregate business deductions of $500,000 do not exceed the sum of the $200,000 gross income plus the $500,000 limitation for married filing joint taxpayers, or $700,000. So it's kind of odd. You actually want the net result of this formula to be positive, and that positive number is actually your limitation. So in example 2, they're actually negative $200,000, so that's not a limit. They can fully deduct the $500,000 in that scenario. So this is a little bit of a gray area right now, just without any further guidance from the IRS currently. Specifically the area around the definition where they discuss attributable to such trade or business, that terminology. It's unclear if that refers to all items of income and deduction other than portfolio or investment items from taxpayers, trades, or businesses. So things like interest, dividends, capital gains. Without additional guidance, a strict reading of the code may indicate that the character of losses and gains is not relevant for this example, or I guess this area. And this specifically, kind of reminds me of the MSR bulk sale concept where potentially you can have capital gains from those transactions. And this would also maybe apply as well to gains from goodwill upon the sale of a business. And so this is kind of unclear if that would count towards the concept of business income. This may or may not be the intent of the code, so it is difficult to say without IRS or Treasury guidance exactly what that attributable to such trade or business means. However, we do feel like if this parallels the passive loss rules, which Code Section 461 is pretty tightly tied to, we know under that code section that capital gains upon disposition of a trade or business are considered passive income. So it's possible that similarly under the excess business loss concept, that these capital gain items would also count as potentially business income. So we do know that guidance is in progress. The challenge is just that we don't know when that'll get released and or passed on to us in the tax accounting world.
An additional part of the tax reform was not to add anything new, or this isn't a new provision, as you are aware, but to make some changes to the depreciation and other cost recovery items, such as Section 179 and bonus depreciation. We'll cover a few of those changes and provide those to you so you are aware of those changes and what those limitations will be going forward. There is an increase in the Section 179 expense deduction. This would be effective for 12/31/2017. Businesses can now fully expense or can take Section 179 depreciation up to $1 million for qualified asset purchases. As you may recall or be aware, this is an increase from the previous limit of $510,000 for 2017. As a note, the term qualified asset would include tangible property, computer software, and qualified real property, which we will discuss later. The Section 179 deduction will not begin to phase out going forward until total asset purchases exceed $2.5 million. The previous limit for this threshold was $2,030,000 for 2017. So as you can see, the threshold and limitations for 179 have gone up pretty substantially. This will provide a great benefit for those who acquire a decent amount of qualified assets and are able to effectively write those off in the first year of purchase and decrease their taxable income. As a note, the dollar for dollar phase out begins to occur when the purchases exceed $2.5 million. So in any taxable year that you acquire more than $2.5 million of assets, that $1 million threshold will begin to decay until it's gone when your purchases exceed $3.5 million. Qualified real property for Section 179 is going to include both qualified improvement property as well as a couple of items that were added to be eligible for 179. Those items would be roofs, HVAC systems, fire protection and alarm systems, as well as security systems. So again, as a note, these improvements were not previously eligible for expensing under the Section 179 provisions. So that is a benefit that will occur if those items are purchased or performed throughout the year. Those will be eligible for that deduction. The definition in the code was revised to collapse a couple of different categories down into one category. Previously, there was qualified leasehold improvement property that was defined. There was qualified restaurant property that was defined, as well as qualified retail improvement property. Those were all defined in the code and had to meet certain requirements to be qualified. However, through the Tax Reform Act, that was all collapsed down into one category, and that new category is now titled simply qualified improvement property. So there'll no longer be those three categories, but rather this one overarching category of qualified improvement property. In defining qualified improvement property, that would mean any improvement to an interior portion of a building, which is non-residential real property. Those improvements would be subject to a couple of limitations. The first would be that the improvements must be placed in service after the original building was placed in service. There may be scenarios where a building is acquired and improvements are made shortly thereafter. It would be important to place that building in service prior to placing the improvements in service so as to allow for these to meet this definition of qualified improvement property and thus be eligible for Section 179 depreciation. Also, the improvements cannot be attributable to a couple of items. The first is the enlargement of the building. Second is any escalator or elevator. And the third is any internal structural framework of the building. Load-bearing walls and some of those types of items would not be eligible to meet this definition. As a note, the code does not specifically assign a 15-year life to qualified improvement property, despite this being the intent of the new law. So as such, any qualified improvement property is technically ineligible for bonus depreciation, which we'll talk about, if there's not a technical correction to the code. The bonus code requires that property must have a life of 20 years or less to be eligible. And it is interesting that the code does not specifically assign that 15-year life to this qualified improvement property definition. As such, without a technical correction, it would receive a 39-year life, similar to a regular building. We would expect a correction in this area through a technical corrections bill, but we'll have to see where that goes in the future. On to bonus depreciation for qualifying assets. Any qualified asset that is purchased and placed in service during the period from September 27th, 2017 through December 31st, 2022 will be eligible for a bonus depreciation deduction of 100%. This has increased from the previous limit, which was 50% for 2017. So again, another taxpayer-friendly change here, which is substantially improving or increasing the amount of depreciation that will be eligible for many taxpayers that fall into this category. As a note, the qualified asset as defined would be equipment, furniture, other tangible property, and qualified improvement property, which we discussed previously, as long as the life is 20 years or less. So again, absent any technical corrections to specifically define the 15-year life, qualified improvement property is technically ineligible for bonus depreciation at this time, despite that not being the intent of the new law. Bonus depreciation will then phase down by 20% per year, starting in the year 2023. It'll go down 20% per year, so 80% bonus in 2023, 60% in 2024, and so on. As a note, bonus is now available for both new and used assets, which are acquired by purchase, assuming that the asset has not been previously used by the taxpayer and wasn't acquired from a related party. Previously in the law, the bonus provisions were only eligible on assets that were brand new. However, going forward, they simply have to be new to the taxpayer, but don't have to be a new asset themselves. Another area of this depreciation and cost recovery would be research and development expenditures. We've worked with many of you in this area and feel that it applies to the mortgage industry. Beginning on 1/1/2022, there will be some changes that take place relating to R&D expenditures. The first is that R&D expenditures are no longer fully deductible in the year they are incurred, but rather must be capitalized and amortized over a period of time. For U.S.-related expenditures, that period would be a 5-year period. For foreign type expenditures, that period would be a 15-year period. So that'll serve to slow down that deduction for R&D, as you are required to capitalize and amortize that over time, as opposed to taking it all in year one. Development of software will be treated as an R&D expenditure. And lastly, if there's a disposition, retirement, or abandonment of property to which R&D expenditures have been paid or incurred, any remaining basis in that property cannot be recovered at that point. Instead, the taxpayer must continue to amortize that over the remaining 5 or 15-year period. That's an interesting section of the code that was added in there. Generally, with an asset, when it's disposed of, the remaining basis can be written off at that point, and a gain or loss will be taken upon disposition. However, in the new law, they specifically state that if there is any basis left in those R&D expenditures, they are not allowing the taxpayers to go ahead and write that off in that year, but instead are requiring them to continue to amortize that over the remaining life of that asset, whether that's 5 or 15 years, depending on the type of expenditure. So that will serve to push that deduction out even further if a disposition is made. And we're on to our last CPE question, number 3.
So again, you should see that on your screen. If you could please submit your answer. Give it some time for everybody to vote. Okay, it looks like everybody has voted. I'm going to go ahead and close that out.
The correct answer to question number 3 was B, 100%.
All right, well, we just want to close today's session here with some information on those that have any questions, who you can reach out to here at Richey Mesa. Again, it's myself, Gina, and Kyle Billman as well, so feel free to send us an email directly or give us a call if you have any questions, or submit any final questions you might have through the CPE desktop structure there, and we'll make sure definitely to get back to you.
All right, so with that, we just want to thank everybody for attending today. Hopefully that was valuable information to you and take back to your business today. Just a reminder that there will be a survey following the closeout of this webinar. We would love to get your feedback on how this webinar went, but also ideas and comments on future webinars and how we can improve. For those of you who did qualify for CPE, certificates of completion will be sent out in the next several days or so, so do look for those via email. And also a recording of today's webinar, as well as a copy of the slide deck, will be emailed to everybody who attended today. So that will either happen later today or tomorrow. So again, thank you for joining us. Have a great rest of your day.